Welcome to this explainer. I'm absolutely thrilled to have you here today. Look, if you've ever stared at a financial chart and just felt, well, completely overwhelmed, take a deep breath. You are in exactly the right place. Today, we're not diving into intimidating math or those incredibly complex financial formulas. Instead, I want you to think of this as learning a brand new alphabet. We're going to decode the language of the market, and I promise you, these charts are just waiting to be read like a really fascinating book. So let's dive right in. Have you ever pulled up a stock chart and just felt completely lost in this sea of chaotic red and green bars? Honestly, it looks like a heartbeat monitor gone completely haywire, right? It is totally normal to feel a bit of that absolute beginner's confusion. But here's the thing, those bars aren't random. Not at all. They're actually telling a very specific minute-by-minute story of human psychology. It's buyers and sellers literally fighting for control. And my promise to you, by the end of this explainer, is that we're going to turn all that visual chaos into clear, actionable stories. All right, section 1, the anatomy of a candlestick. We're going from the micro to the macro. Before we can actually read the market, we've got to learn our basic letters. So let's zoom all the way in on a single candlestick. Think of the thick, colored part of these shapes, what we call the body of the candle, as a massive visual tug of war. It's buyers against sellers. Now, a green candle simply means the closing price at the end of a given time period was higher than the opening price. The buyers pulled the rope across the line and they won. Simple enough, right? On the flip side, a red candle means the closing price is lower than the opening price. In this tug of war, the sellers yanked the price down and took the victory. It really is that straightforward. Green means up, red means down. But hey, the story definitely doesn't end with just the body. Notice those thin little lines sticking out of the top and bottom of the candles? Those are called candle wicks, or shadows. If the body is the final result of our tug of war, the wicks are the actual battlefield. They denote the absolute highest and lowest points the price reached before the final winner of that time period was crowned. So a long wick tells us that during that specific time, someone made a massive, massive push to move the price, but they were eventually beaten back before the clock ran out. Okay, section 2, the 10-minute chart. Let's take this from theory to practice. Let's apply this anatomy to a real-world scenario so it really clicks. Imagine you open up a chart tracking 10-minute time blocks. Step 1. At exactly 9:15 a.m., the market opens, and let's say the stock is trading at rupees 230. That's our opening price. It'll be either the bottom edge or the top edge of our candle body, depending on how things play out. Step 2, well, the market's a chaotic place. For the next block of time, the price constantly fluctuates in that tug of war we talked about. Buyers push it up, sellers drive it down, creating those wicks. Then we hit step 3. At exactly 9:25 a.m., this 10-minute period officially closes. And when the dust finally settles, the closing price sits exactly at rupees 233. So here's a quick challenge for you. What does our candlestick end up looking like? Let's deduce this together. We opened at 230. We closed at 233. Because 233 is obviously higher than 230, the buyers clearly won this round. So the resulting candle printed on your screen is going to be a proud, solid green, with its body stretching right from 230 up to 233. Moving on to section 3, market patterns, specifically bullish and bearish patterns. You know, you've literally just read your very first word in the language of the market. Now we get to put those words together into sentences. When we analyze these charts, we're generally looking for two types of stories. On one side, we have bullish patterns. Think of these as the ultimate comeback stories. They show us that buyers are bouncing back from intense selling pressure and are gearing up to push prices higher. On the flip side, we have bearish patterns. Now these are warning signs. They indicate that sellers are gaining control and a previous uptrend in price might be coming to a pretty harsh end. So let's look at what these actually look like in the wild. This next concept brilliantly illustrates our first bullish pattern. It's called an inverted hammer. Now, notice where it shows up, right at the very bottom of a downtrend, usually after a string of red candles. It's got a small green body and a really long upper wick. So what story is this telling us? Well, the long wick shows that sellers tried hard to keep pushing the price down, but buyers stepped in with incredible force, driving the price right back up. It perfectly captures prices bouncing back even after heavy selling pressure. Basically, it's a huge signal that the trend might be flipping to bullish. Now, let's contrast that with a bearish signal known as the hanging man. It looks a bit like a hammer, sure, but in trading, location is everything. This guy forms at the very top of an uptrend. If you see a really long lower wick on a red candle up there, it means the buyers desperately tried to keep the prices up where they had been, but they entirely failed. The sellers push the price down significantly during that period. The sellers are ultimately gaining control here, which is a massive clue that the uptrend is likely over. Let's move to another incredibly powerful bearish signal. This one is called the bearish engulfing pattern. And honestly, it's visually striking. We start with a smaller green candle, which represents a tiny bit of buyer hope. But immediately after it, a massive red candle forms. It opens higher, but then absolutely crashes down, closing much lower. That red candle completely swallows or engulfs the smaller green one. It's just a dramatic visual representation of a total shift in power. The sellers have entirely overwhelmed the buyers. No contest. Finally, let's talk about the shooting star. Remember that inverted hammer we saw earlier at the bottom of a chart? Well, if that exact same shape happens at the top of an uptrend, it gets a brand new name, the shooting star. And spoiler alert, it becomes a bearish signal. That long upper wick proves that buyers tried to push the prices even higher, but they completely failed. The sellers swept in, took total control, and pushed the price all the way back down to close near the open. If you see a red candle following a shooting star, that's your strong confirmation that a downward reversal is absolutely happening. All right, section 4, your next trading steps. Let's put this all together. You know, you've done a fantastic job navigating these concepts today. We covered the basic letters, the anatomy of the candle, and we've actually started reading words by identifying bullish and bearish patterns. I want to leave you with this direct quote from our source material. With dedication and patience, you can become a successful trader. Look, reading these charts, really understanding the tug of war between green and red, and spotting those engulfing candles or shooting stars, it takes practice. You aren't going to recognize them instantly every single time, and that is completely okay. It's a skill, and just like any skill, it is entirely achievable if you put in the time to study the anatomy and watch the live battlefield of the market unfold. So I've just got to ask, are you ready to open a chart and start reading the market's secret language for yourself? You have the foundational tools now. You know exactly what the wicks mean, you know what the bodies mean, and you know how to spot the turning of the tide. The next time you see that massive sea of chaotic red and green, you won't see chaos anymore. You're going to see the story. Thank you so much for joining me for this explainer, and hey, happy charting!